Hello, everybody. Welcome to Zach's Corner with John Graham, BM2 Freight, and Zach Rogers, Associate Professor of Supply Chain Management at Colorado State University, where we go into the weeds with Logistics Managers Index, LMI for short. We talk about, obviously, changes in the supply chain, transportation, and logistics networks as we hypothesize change in the future. All right, Zach, you want to kick us off with LMI and your elevator pitch?
Sure. Yeah. So yeah, thanks for watching whoever's out there. So this is the Zach's Corner for the February 2022 Logistics Managers Index, which came out the first week of March. And for those of you who aren't familiar with the Logistics Managers Index, first, what are you doing? Second, here's a quick
Educate
sort of
yourself.
description of it. So we ask, a couple hundred managers every month, hey, these 8 metrics: inventory levels and costs, and warehouse and transportation prices, utilization, and capacity. Going up, going down, staying the same. Any number over 50 means growth. Any number below 50 means contraction. This month, our overall number was a 75.2, which is the second highest reading in the 6 years, essentially, that we've been doing the LMI. There was only one reading back in April of 2018. John, if you remember April 2018, that was right as the sort of after effects of the tax cut were at its height. Remember, that was January, and then April we were like at a 75.7 or something like that. But so we're close to there. We're close to there again now. Here's the interesting thing, though. That was sort of that tax cut. That was like we went up really quick and then we went down pretty quick after that. Remember, like fleets were getting built up, and then by the time we hit 2019, it's like we have too many trucks on the road. 3,000 small carriers are closing down between 19 and 20. And so it was sort of a up and down really sort of quick. If we look at what's happening now, we've been in the 70s since February of 2021. So over like a full year now, we've had readings in the 70s, which, before like September of 2020, when we started to really see this capacity crunch, we had not been in the 70s very many times. We were mostly, 60s, 50s, and that's where you would expect us to be, right? Because that's like a moderate rate of growth. But right now we're at 75, and it's interesting to think about why we're at 75, because it's not just the same old story that we've been telling during most of 2021, where it was, oh gosh, sky high freight prices, sky high warehousing prices. That's still a piece of it, but there's a key change this month that you can see on this graph here. So what this graph does is it shows us inventory levels, which is the blue line, as well as our 3 cost metrics. So orange is inventory costs, brown is warehousing costs, and yellow is transportation costs over essentially the last 2 years and change. And I think it's interesting to look at the slope on that blue line. It's like that kind of hockey stick graph happening right now, where inventories are building up like crazy. And this is particularly, by the way, durable goods inventories that we're talking about here. And I think it's interesting to look at. I've sort of highlighted, where it's been for the last couple Februaries, as well as like say November, and you can see, 19 to 20. Oh, it actually went down 6 points from November to February. 20 to 21, it went up 2 points, I think. And then this year we went up 22 points.
It almost
Normally
feels like it almost feels like that bull lip is starting to, get
oh,
some
absolutely.
tension on it, right?
This is great because I actually played the beer game with my classes last week. So this was like perfect timing by
Right.
the economy to really drive home, the spring 22 semester of intro to supply chain classes.
Right.
But you can see what normally
It's a
happens is
living
November,
model.
December, right? Very serendipitous for me because I'm not managing any of this inventory. November, December, we always see this dip, right? Here, there it is there it is there. And then this year, inventories go up. How does that happen? Well, consumer spending, when you adjust for seasonality, was actually down by like 0.6% in December, which never happens that spending goes down in December. But
Well, we did
Omicron
see that.
happened.
influx in, October where retailers were flattening the curve, right? Because
Exactly, right. We were like, oh, well, we'll have
inventory
Black
cycling.
Friday will go all month. We'll have all these big sales because this idea was consumer spending so hot, it's gonna. I mean, and we even said this, I think, on some of our episodes. Like when we were in August, we are like, where's this gonna be in December? Because everything's crazy now. And I think what we didn't consider is that eventually what goes up has to come down with that, right? I mean, we talked about it, but we were like, well, I mean, it won't happen in December. I think everyone kind of thought Christmas, holidays be crazy. And then we'll get on the other side and we'll see the slowdown. The issue is the slowdown happened a month early because of Omicron, some shutdowns there. Plus, we worked through all of our savings accounts, basically. We had those 3 big stimulus checks. Stimmy was gone by the time we got to December and January. And so we saw huge dips in consumer spending at the same time when retailers, particularly retailers, but really every part of the supply chain, had been way over ordering on goods, basically. And
Yeah.
and you run into a situation where stuff that you were hoping to have on the shelves for, Christmas shows up in mid-February. And then what are you going to do with it? And we have some companies right now that are so over leveraged that quite a few of them are basically paying for the inventory, right? Paying for those high costs to get everything over by using their inventory as collateral for like supply chain finance loans. And so it's a really kind of interesting space, and this has a ripple effect because it's not just that, okay, durable goods, consumer goods, we have a lot of it. Right now, what durable goods is doing, and this is the reason why I included all these costs on here, is they're soaking up a ton of capacity, right? So they're taking a lot of trucks off the road. They're filling up shelf space in store and in warehouses. And it's just gumming up the works for supply chains where we can't keep moving things around. You see, we still have these really high cost growths. Everything's in the 80s, high 80s, and then inventory cost, which is in the 90s, first time ever, by the way, in the 90s. And basically what's happening is we went from costs were really high in 2021 because, and you can see, okay, inventory wasn't growing that quickly because we couldn't keep it on the shelves. And so we had this sort of dynamic utilization of capacity where things were turning over really quickly, and that drove up costs. Now we're seeing a static utilization of capacity where we have inventory, that graph is going up like a hockey stick, and that's still, driving high costs. But now it's not high cost because it's moving quickly. Now it's high cost because everything's all filled up.
Yeah, and we're starting to talk to some manufacturers where their key suppliers are still having issues with raw materials and things of that nature, where they're still stuck in some of those bottlenecks where, kind of outside this graph where, I've gone to some conferences, this, that, and the other, and I'm looking for people that give me kind of an overall general, you've had enough runway, to implement change or different strategies that may work for your specific business, given your business rules. And everybody's just kind of like, we're just doing what we can to stay functional. And the conclusion is, as it has been for quite some time, sometimes you just got to do it the hard way.
Yeah.
Right. And, with respect to, this chart and these graphs, right? You see all these inventories coming up, and I'm like, man, that secondary market, it's like just, I mean, are they going to start opening up more brick and mortar for dollar stores and Dollar Trees here pretty soon? Would be a good indicator of.
I don't know how much quicker they could open them. They've opened something like 2,000 Dollar Trees in the last couple of years, and Dollar General. If you look at the stores that have added the most square footage over the last 5 years, Dollar Tree, Dollar General, Walmart. Those are the three. Those are the three that we've added the most square footage.
I love the waterfall of the same products, right? Like, you can buy it here for this price, then in 6 months you can buy it here for, a fraction of that cost. But I guess at the end of the day, whoever's widget that is still making a margin on that product, right? So
it's why there's now 120 more Nordstrom racks than traditional Nordstroms. Which is true. That's where people go.
Yeah, which really is interesting. I wonder what's outpacing the secondary market or reverse logistics, right? The returns, right? You know what I
Yeah.
mean? It's,
So we
it's the
always kind of mesh
recycled
them
goods
together, So
versus,
so basically everyone I've talked to right now is saying the split is 65-35 um overstocks over returns. Right?
yeah,
So it overstocks is bigger. By the way, we estimate the total size of that market every year. And in last year it was 642, 43 billion dollars. I know it works out to 3.1% of GDP.
yeah.
Is just overstocks and returns, which is so funny. It's like one of the big, other than like maybe transportation and healthcare, it's like the biggest part of the economy. But we don't really think about it that much because like, oh, those are returns. I mean, there's no one big. I had a great chat with a reporter from CNBC a couple weeks ago, and she was asking me, so how come there's no big conglomerates in the returns business and reverse logistics? How come there's no one I've heard of the same way you would have for everything else? And I said, well, partly it's very fragmented, and by nature the margins are kind of funny. And they said, plus 30 years ago it was all mafia anyway, so so they weren't incorporating. And I mean, of course, you have the Inmars, the Opturos, you have the big guys, of course, but it's no one has that type of market share that you see in other more mature industries. And I actually think one of the fascinating things for the logistics just whole community over the next few years is going to be the proliferation of software solutions systems aimed at reverse logistics.
I mean,
I'm working with a
it's already
company right
there.
now, and it's absolutely blown up.
Yeah, no, it's already there for sure. But again, how does that meet those objectives for your unique organization? How do you tie it back into, the enterprise
Right.
wide, right, network? And you were talking about the volume and a huge shift in that kind of, in your process management alone would take a massive undertaking, right?
Mm.
So I think, if an organization, I think that, top down, they would have to be a pretty solid alignment and investment, right, to see that ROI, and it might take a minute, right,
Right.
to
Not
see.
everyone can be Amazon and just say, "Hey, Kohl's, will you manage our returns so that people actually go into your store?" Sometimes, not everyone, not everyone else can do that trick.
Right.
Um, so related all everything we're talking about is this graph here, which is capacity over the course of the last 2 years, and it's nice that we finally have now gotten to the point where 2 years ago was the start of the pandemic. Actually, the day we're recording this, March 11th, it's 2 years to the day. Remember that one day where suddenly Tom Hanks and Rudy Gobert had it, and we were like, oh, I guess this is real now. If Forrest Gump and the Center for the Jazz have kept COVID, I guess we all got to shut it down.
I
And
think it was
so,
real when your kids can't come back to school after spring break. That's when it was
exactly.
like,
Well,
that's
spring
when it
break
hit home.
starts. You're probably in the same place. Spring break starts like today in Colorado after they get home at 2. So, yeah, this is exactly when it happened.
Like, oh, we're gonna extend it. Okay. Oh, I didn't realize it was like a year extension. Wow,
Yeah, we're gonna extend it till at
that was
least
long.
next, yeah, like President's Day.
I was
There
planning
was
for a
like a
week.
month. There was a month where they went back, like in October. But so anyway, and by the way, on the teaching side, that was a very necessary extension because I was like, what's Teams? I had no idea. Um, so anyway, if you look at these two lines, green and gold for the number 25 ranked CSU Rams right now. So these are you can see they've basically been in contraction mode, 18 months at this point for transportation, and about that long for warehousing as well. And until this changes, until capacity comes back, until it gets online, there's just going to be a ceiling on the
I
economy.
would
And now I
call
think we're in an
I would
interesting.
call capacity kind of more of a balance, right? When we're going that 1-to-1, right? One, shipment per one,
Mhm.
carrier, right? And as things balance out, there's a good utilization versus we have so much tonnage, right? And we only have X amount of capacity right? And transportation is really kind of a simple economic principle, right? It's supply and demand. So when the tonnage comes down, right, and this is the 100-pound elephant in the room right now is fuel, right? What is fuel going to do to everything, right? And we talk about, 70% of consumer spending, right, affects that tonnage or available tonnage for hire out there, right? It has a direct effect. Plus, obviously, the carrier's ability with diesel prices going up, 80 cents in a week.
Yep.
Posted on Monday, right? Every Monday, these things get posted. And obviously, this affects things regionally differently. Speaking of averages, but what is this going to do? It's still really fresh, right? So obviously, the carriers are getting pinched. However, from my vernacular, right? I mean, we've talked about backhaul rates and spot market rates being so inflated, right? Will they be able to absorb those? Additional fuel costs, right? Because shippers are going to be like, we have, pass through programs, fuel surcharges basically pass through to carrier providers pretty significantly. But
Exactly.
a lot of times that doesn't necessarily align to a person's operation, when it gets down to, the driver on the road paying the cost, right? And if he's not getting recouped that, those situations are highly fragmented,
trick,
right?
right?
So
That's the trick with capacity is it's not that here's our static need for capacity. We have to build to get there.
right.
We're going to meet in the middle, right? Because the need for capacity, right? You would think there's going to be some drop. And specifically on like long haul sort of side, the short haul, the next day delivery stuff, that I don't see dripping in any significant way in the near future because of the increased importance of e-commerce in terms of the overall, right? In terms of the overall retail. But it is funny, and I brought this up because I realized my screenshot, I tried to highlight 3.7. I'd accidentally highlighted 228. And normally that's not a big deal, like, oh, only off by a week. But this week it was a big deal. Because we went from 370 to 420 basically, and this is for everything together. This isn't just diesel, so you could obviously split that out as well. But I do think it's interesting to look at that really sharp jump up, especially after we had kind of a gradual. I mean, we really had sort of, if you look at the just whole of this, right? We had a fairly stable time. I mean, of course, there's the peaks and valleys, but there was some stability, I think, in the last 5 years before we hit COVID. And now we've been on an absolute roller coaster. It'll be interesting to see where this goes because, the underlying issues with the high fuel prices are not anything that's going to be resolved soon, right? You have the issues with Ukraine. You have all of the, whatever's happening with international trade and markets that you won't see that, I don't think, wrap up. And so you do wonder if the high costs will eventually sort of bring down demand for capacity. Now that didn't happen last year, right? It didn't happen last year. We had record, prices people were paying for logistics, but partially you could pass that number on to the consumers because of all the stimulus, right? Consumers were able to absorb more inflation last year because, wages were going up. We had literally trillions of dollars injected into the economy.
Inventories were cycling, money's turning over, and obviously the transportation cost, from LMI, standpoint, it was continuing to trend with it, right? So, carriers are making banner years and making lots of money. So, they're not feeling the pain, if you will, right? I think the pain really is on, all of us, when we go to the pump with our SUVs, right? Filling it up. I'm glad I have an e-bike all of a sudden, right? Just need to get snow off the ground. Like an elephant on roller skates on ice.
Right.
But furthermore, to the point is, it makes people pause, right? Everyone wants to see what happens. Are we going to continue to, hey, we have a project for summer, right? We're going to build a deck, right? Are we going to continue to do that, or are we in fear of recession, right? And fear obviously evokes a lot of emotions and spending and things like that, right? So it's really going to be difficult to say, what the spending patterns for us as consumers out there how we're gonna react to these high fuel costs, right? And now I think that'll
So
directly affect the.
maybe you can build a deck if you can get the construction materials.
You don't want me to build your deck. I'll
You know,
tell you that.
it doesn't seem like, based on the predictions of our respondent base, okay? And most of our responses came, by the way, after for February, came after or at least right before the sort of writing was on the wall with Russia and the Ukraine. You know, I think they invaded February 24th. The way that our responses work a lot is like everything in logistics. It's JIT, right? Well,
Yeah.
we're always predominantly skewed towards sort of the end of the month with these numbers, which actually we prefer because it gives us the most recent kind of snapshot we can get. And so some of this is already baked in here. Now, will it be some movement? Maybe, but I do think, in terms of, is there going to be a recession this year? I would be surprised if there was a serious recession this year, and this is kind of why. So, if you look at predictions for the next year, you know, LMI at 70, that's pretty close to where we were at last year. Building in some new capacity, which would be nice, right? There's a predictions that warehousing and transportation capacity will actually grow over the next year, which would be
Yeah, I mean, trucks are going to start to. There's new equipment's going to start to hit the road eventually, right?
Yeah, for a
Driver
year and a
pay.
half.
There's more drivers entering the workforce. There's still the debate of the age of drivers going on, right? So
As
yeah,
long as we
there's
don't keep putting dumb restrictions on how you can get your CDLs, we'll be we'll be fine. Um, but you know, overall, it looks like there'd be some price growth. Now, price growth moderated somewhat, and interestingly, inventory is expected to continue to grow at a pretty significant clip. That's 74. That's what, you know, that would be till we hit 80 this month. 72 was the highest inventory levels had ever grown at. So this shows like inventory is going to keep pouring in because we cranked up the machine so much last year. And it'll be interesting to kind of see, you know, will this eventually drive costs down? That would be it, because there's going to be kind of two competing forces where we have these crazy high logistics and fuel costs, but then so much inventory. And it's, so what happens to prices? And maybe it just breaks even.
Yeah, it's going to be a competitive market, right? For this similar competing products, right? That's an obvious outcome. I mean, potentially.
Exactly.
Right. Or, who, again, competitive nature can come in different ways, right? So you sourced all this product and you have it in, how fast can you get it to your customer? Can you get it same day, right? Next day. So the omni-channel game is, very much in effect, right? How easy to do business. Amazon's pretty easy to buy things on, right? Shows up at your door, right? So I think there's certain things that retailers specifically, right, are doing and continue to invest in for the consumer experience. And when things do balance out and cost can be a unique tool. I mean, obviously, who's got a better plan is probably gonna see results, right?
Absolutely.
So it's gonna be interesting this year as things, like you said, start to well, I say balance out. But yeah, fuel has definitely thrown a monkey wrench into all. I'm just sitting here going, man, I wonder how many analysts this week had to go back to modeling, right? Hey, okay, so all those models that we did, in Q4 last year, can you redo all those with this new fuel?
Well, it's so funny,
And spit out the outcomes, please.
Because we have a shortage of, say, like chips and semiconductors, which makes it difficult to increase supply, right? But then at the same time, now we have this increase in fuel, which is going to make it hard for demand. And so you wonder if there's some counteracting, like the kind of the supply chain issues we've been having have only been hurting us on the supply side for the last year. Now they're going to be hurting us on the demand side a little bit too, which, is that good? No. But will you see some equilibrium? That's possible. It's possible that two wrongs could make a right in the case of supply chains in 2022. It's just going to be really interesting to see where that goes.
Or what I learned at Kansas University, two right turns make a U-turn. So
Go
we know we're in
Jayhawks. All right.
All right. Well, Mr. Rogers, always a pleasure. I think we we got lots to talk about next month's LMI as we see the effects of fuel and LMI indexes, and as we continue to hypothesize change and balance out and all things that are good in the supply chain, transportation, and logistics communities.
Yeah, those fuel costs will definitely be folded in. They were folded into February somewhat. They'll be fully folded into March. It'll be interesting to see, if we see another big spike with the transportation price, or if it's moderated. I think by that potential downshift in demand. It'll be out the first Tuesday of next month, which I believe is the 5th, maybe. Which, by the way, is a nice relief because the first Tuesday of February and March were both the first. So I had to stay up all night writing these the last couple months. So this will be
I
great
just
to
did
have the extra
this.
days. Yeah.
Well, awesome. Well, thank you again. It wouldn't be Zach's Corner without Professor Zach. And
Or John.
thank you everybody for paying attention.
Thanks, everybody.